Well, it finally happened. 33 days the S&P went without dropping at least 1%. And on Friday, the S&P dropped 2.5%. The NASDAQ dropped 3.5%. So obviously the question on everybody's mind, is this the start of the AI bubble burst? Is this the start of something greater than just a typical pullback? Everyone watching this is likely worried about their money. So I'm going to try to answer that for you as best as possible and give you some practical scenarios and some practical solutions depending on the type of trader and investor you are, how you want to tackle this going forward. Let's get right into it. So why did the S&P 500 drop? Well, let's leave the Trump news aside for 1 second. Like I said, we went 33 days without a drop of at least 1%. From the bottom in April to the all-time high, the S&P 500 went up 40%. You don't need a real reason for the market to pull back. Everyone and their mom knows that the market was due for a pullback. Well, here's the pullback. And before we get into a deep dive and I tell you how I would handle this depending on what your situation is, let's just talk about the news catalyst a little bit. So basically, Trump put out a Truth Social saying that what China was doing with the export controls as it relates to rare earth materials was unacceptable, and that he was contemplating putting a 100% tariff, additional tariff on China by November 1st if China does not release the export controls on these rare earth materials. Now, for those that don't know why rare earths are important to the US, yes, they are used in TVs, LED lights, MRI scanners, etc. But more importantly, the US should probably look at solutions to overcome this. Rare earths are used a lot in the U.S. military. They're used for F-35 fighter jets, submarines, lasers, satellites, Tomahawk missiles, and more. So rare earths are very vital to U.S. national security. The only problem is most of the rare earths come from China, or most of the rare earth production comes from China. Now, even the rare earths that we mined in California, we were sending over to China for separation, for processing. Something is clearly broken there. So because of that, Trump said that he was going to place a 100% tariff on China and that he was going to cancel his meeting with President Xi, or was thinking about canceling his meeting with President Xi. Then the market reacted awfully, and Trump said that he has not canceled his meeting with President Xi and that they might still have the meeting. And then over the weekend, when I'm recording this, China says that the recent change is not a full export ban. They're open to more dialogue, and that the relevant impact of these export controls should be very limited. And honestly, since Liberation Day, it's not like we didn't have any headlines related to tariffs. It's that the market wasn't in a position to overreact to them. But like I said, when the market gets so frothy and hasn't reverted to the mean in so long, and we'll talk about this a little bit more when we get into the analysis, then the market is going to be susceptible to major news headlines. So, back in June, we did have a tariff headline, but it did not rock the market like it did last Friday because the market was still in an upward trend and wasn't far removed from what happened in April. But now come October, we didn't have a significant drop in August. We didn't have a significant drop in September. Both months are really months that are subject to seasonal volatility. And so come October, it just tipped over the fence. Now, right now, as at the time of this recording, it's October 12th. So November 1st is a couple weeks away. The government is still shut down. October could be subject to a lot of volatility. But I suspect just based on recent history, there won't be anything serious that comes out of this, that it will be resolved, in my opinion. All right, now let's dive into the technical analysis. Everybody wants to know, is this the bottom? And I promise I will give you some practical solutions, or at least some mitigation strategies, depending on what type of investor / trader you are. Let's take a look at the VIX, right? I told you guys that I was expecting the VIX to pop within the months of August through October. Now, what this isn't going to be, it's not going to be an I told you so, okay? Nobody's a freaking genius here because nobody knows the exact date that this is going to happen. Even me, I had a VIX hedge open in August and it didn't pan out in August. I rolled it to September. We did get a little bit of a pop in September, nothing too serious. And I ended up saying, you know what, this hedge is costing me too much. I'm making a lot of money with these stocks appreciating. I don't want to keep digging into my profit by continuing to buy hedges. So I let the hedge expire. And then come in October, the VIX raises by 32% in one day. So yeah, I'm not going to call myself a genius for saying, oh, the VIX between August and October is going to rise, and then for 2 months being wrong about it, and then October, the VIX finally rises, right? Nobody could have predicted this. So any post that you see online, like I told you so, usually those bears are, predicting a crash every single month. And then the one time we get a 2.5% drop, the I told you so's come out. But either way, the VIX was definitely coiling very tightly, as you could see here. And we finally did get a pop. Like I said, when there's complacency in the market with regards to asset prices climbing with no mean reversion, and when the volatility index has been really quiet and it starts to coil, then it is susceptible to any major headline that otherwise wouldn't have caused this type of destruction in one day. All right, now I took a look at the trend lines on both the NASDAQ and the S&P 500, and here's what I find extra interesting, guys. Whether this is the bottom or not will depend largely on what happens on Monday, October 13th. And the reason I say this is because the NASDAQ and the S&P 500 are reliably strong in predicting the break of a trend. So when we have a trend that has at least 3 touch points, we tend to drop by at least 5% every single time. The NASDAQ way more than the S&P 500 in terms of the strength of the drop because it is more concentrated. So if you look at the NASDAQ, for instance, right, you look back here in 2024 to 2025, when that trend line has broken, then we dropped 25% from the peak. Back in 2024, when that trend line was broken, we dropped 15%. Back in 2023 to 2024, 7%. Back in 2023, we had a break of this trend line, 11%. And then obviously the bear market of 2022, same thing. We had a trend line, a clean trend line that was then broken on the daily. So this right here is Friday's candle. If we get another print lower, then I think we get into at least correction territory on the NASDAQ, hitting that 0.3 of the Fibonacci, which on QQQ would be around 548. The S&P 500 is very similar. Let me remove these moving averages because I will use them in a second. But the S&P 500 is very similar. However, the strength of the drops are not as concentrated as the NASDAQ. So you can see here, this break of trend line led to a minus 19% drop, which was Liberation Day. This was -8, -5, -10, -7, -16, and this here was the 2022 bear market. But you can go back over a decade, and the trend lines are extremely reliable on both the S&P 500 and the NASDAQ. Now, let me pull up the moving averages real quick because this gets real interesting. And this right here is proprietary research. I didn't get this from anywhere. It was just me looking at this all night. And I noticed one thing, guys. Remember I told you that August through October, we tend to get seasonal volatility. And even though I was, made fun of in August and September saying, hey, where's the drop? Well, I'm not Nostradamus, right? I just know that August through October tends to be volatile, and we tend to see a mean reversion. So much so that you have to go back to 2009 to spot a time where the S&P 500 has not hit the 100-day moving average from August to October. So I'll say that again. You have to go back to 2009 to spot a year where the S&P 500 has not hit the 100-day moving average between August and October. Whether we're in a bull market or bear market, it rang true. As of now, the 100-day moving average on the S&P 500 is around 6,300, and it would take us to about a 6.5% drop from the top, which is a respectable pullback, not correction territory. So if we get a red day on Monday on both the NASDAQ and the S&P 500, and it is a red day with a full body close, not just some wick and then back up, then I think that we are likely due for a pullback to at least the 100-day moving average on the S&P 500 and a correction on the NASDAQ that will take us down about 10%, in my opinion, at least. Now, the one thing that is kind of an anomaly and is kind of scary, or maybe something you look forward to depending on how much cash you're sitting on, this weekly gap here on the S&P 500. So there's a weekly gap between 5,600 and 5,800 that hasn't been filled. Now, I went back on the weekly on the S&P 500, not SPY, because SPY is a stock. It's an ETF and it pays dividends. And so you do see gaps in the SPY based on dividend adjustments, etc. But SPX doesn't account for dividends because it's not a stock, it's an index. And I went back and I looked, and there are not any unfilled air gaps on the weekly on the SPY going back at least 50 years. We do have some gaps which we call volume imbalances, like this, as you see here, where it is not a full air gap. There was still a wick, for instance, in between this body close and this body close, right? There are a couple of occasions where those are left unfilled, but a full-on air gap, as you see here, between the actual, including the wicks, between the candle including the wicks and the next candle including the wicks, there aren't any. And if we draw this out, I particularly think this is low probability on this particular drop. But if we do get to that level, we still won't be in a bear market. We're still talking about, a 14 to 15% drop here. Now, if we go back to the times where the S&P 500 fell 2.5% while making an all-time high, this is actually pretty common. And you can see here that within a couple weeks of that event, it tends to get pretty volatile with mixed results. But usually a month to a year later, that volatility tends to get resolved. Now, what should you do in this situation? Okay, first and foremost, if you are someone who is just trading and you have a lot of leverage positions open, you guys already know since August, I've been telling you guys that August through October, you do not want to be in too many leverage positions. In my opinion, at that time, I said you want to be selling your leveraged ETFs like TQQQ, SOXL, something that I did. Obviously, you don't want to be in huge options positions. When we enter periods of volatility like this, you essentially want to do a few things, right? You want to lower your position size. You want to lower the number of similar positions. What I mean by this is if you are long on Meta and Amazon and Palantir and Nebius and CoreWeave, and you're just long a wide variety of stocks with leverage. I'm not saying if you own the shares. I'm just talking about people who now have leverage. That is essentially one big position because you are long many stocks during a time of volatility. So you want to lower your position size. In my opinion, you want to lower the number of positions that have the same bias, and you want to limit short duration plays. So let me give you an example. For instance, if you are bullish on Amazon here and you think that Amazon will get to all-time highs, you don't want to bet that that's going to happen in the short term. In this case, you would want to buy leaps or end of the year in the money calls, but you don't want to bet in the short term in 2 weeks or a month that Amazon is going to go from 216 to 243, even if it does. That is just a terrible way to trade in these conditions. If you are a long-term investor, then really these short-term price fluctuations should not scare you out of the market, especially if you did your job and bought the last time that we had a correction. So if you bought NVIDIA below 100 or below 90, you probably have very little to worry about if you truly are a long-term investor and you're not looking at your portfolio day to day shivering in fear. If you bought Google at 140 and it recently hit 255, what do you have to worry about if you are a long-term investor? The only thing that you should be thinking about is what you are going to accumulate and when. Because if you are a long-term investor, and I should add the caveat that if you have a time horizon, an actual time horizon, and you're not retiring within the next couple of years, you want to be invested in all days. If you look at this study done by Fidelity here, if you miss the 5 best days in the market going back to 1988 to now versus being invested all days, the difference in gain if you invested $10,000 between being invested all days and missing just 5 of the best days within that 36-year period, look at the difference, 522,500 versus 330,000. If you missed the 10 best days, you made less than half, just 10 of the best days in 36 years. Now, if you are someone that doesn't have a long time horizon, I told you this since August, that the risk reward or the cost benefit of you trying to ride out the last few months of a bull market versus the threat of a major correction happening in the very short term, in my opinion, it is not worth it. And if you have a very short term time horizon, then you should enjoy the gains that we already made up to this point. In my opinion, you could do what you like, obviously, but time horizon does factor into your decision. The more time you have, the less you have to worry about. So once again, if you're long-term focused, you should right now be studying, looking at companies that you want to pick up. So for instance, the thing that happened on Friday with the tariffs, right? If you look at something like United Healthcare dropped 3.6%. Because of that announcement, the overall market dropped, and a rising tide lifts all boats. The same is true opposite. Is United Healthcare worth 3.6% less because of rare earth materials and because of the fact that Trump might put 100% tariff on China? No. Is Uber worth 3% less because of that? No. So you want to start putting together a list of things that you want to buy and levels that you want to buy them at. This is going to likely include a mix of technical and fundamental analysis. And if you have no clue and you need direction and you want to know what I'm doing in real time, make sure you sign up below. And I go live every single morning at market open, by the way. This volatility is going to create a lot of opportunities coming in the next couple of months, in my opinion. So you definitely want to be on the right side of it. And lastly, if you're a trader, you love this. You love this type of volatility. The sleepy price action that we saw in August and part of September, that's out the window. We are going to get volatility, baby, and it is time to trade that. Whether that includes shorting the VIX at the right time, shorting the indices to these key levels if it confirms, longing them through the end of the year. These are things that will take a lot of precision and a lot of risk management. So in conclusion, I think you have to wait for Monday's price action. But if we print another red candle, then I think that those corrections that I talked about at those key levels are a plausibility, are the most likely scenario, in my opinion. If on Monday there's heavy backtracking by the Trump administration, by China, de-escalation, and we get some sort of wick that then pops up and turns green, then I think that it is less of a confirmation, and this retracement could be it through the end of the year. And one more thing to keep in mind is that earnings are coming up as well. So Q4 earnings are coming up, and by third week of October is when the interesting companies and the Mag 7 companies, etc., start reporting earnings. And in my opinion, those earnings will likely be strong and will quell any fears that the AI bubble is about to burst right now. I do think we are in a bubble. I've talked about it before. I do think that these circular deals are definitely an issue and will be part of the reckoning of the AI bubble burst. But in my opinion, I don't think that's going to happen right this second. Anyway, traders, let me know down below. What do you think about the state of the market? Are you out of the market? Are you piling up cash waiting to buy stuff? If you are, what are you looking to buy? What are you excited to buy? Do you think that this is the beginning of the bubble burst? Do you think that this is a nothing burger? Would love to hear from you. Leave it down below and sign up if you want to trade with me live and you want some direction on what I'm doing in this scenario in real time. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.